Hello, everyone. Welcome to our session today. We're going to talk about some wealth planning strategies and probably more importantly, discuss some of the estate planning proposals that are currently out before Congress and see how that plays out in our estate planning world. I am Ava Archibald. I'm our principal in charge of our wealth transition services. I am based out of our corporate office out of Fargo, actually live in Minnesota and work remotely. Today I am in my Fargo office here, and I will say it's colder than some of our office locations already in October. If you're not familiar with our service line, we are the Wealth Transition Services of Eide Bailly. We're the service line that provide services for our clients in regard to estate planning, estate and gift taxes, generation skipping taxes, fiduciary income tax returns, and many times business succession planning. As we work through a successful estate plan for us at Eide Bailly, since we are an accounting firm, when we do an estate plan, we're always looking at it from the tax perspective, and that is our goal, to look at a holistic approach for our clients and their families, and how best can we transition that wealth down to the next generation and do it in the most tax efficient manner. In doing so, we're always listening and concerned about family dynamics, or what's important, what are the family goals overall, and most importantly, we are looking to be sure that with whatever plan we may put in place, that when our clients walk out the door, that they feel like they still have the same accustomed manner of living. The estate plan we put in place is to save taxes for the family overall, but also allow them to have the same cash flow or maintain the same lifestyle that they had previously. It's really four things we look at when we do those plans. We assess, educate, illustrate, and implement. Assess is looking at what have you already put in place? What is your net worth? How do you hold those assets? Who are the key players? Who are the family members? We need to look at that overall picture. And then we move into educate. And educate for us at Eide Bailly, when we do planning, we are taking that planning approach, knowing what is the law we have today, knowing how that affects what plan you have in place or what changes you should make, and also keeping in the back of our mind the proposals that are out there. And I will say, in my 30-year career, I have never seen so many estate tax proposals in 1 year as I have this year, which I'll address here in just a minute. The next step we do is illustrate. We want to make sure when we do planning with our clients that there's a good understanding of how this plan will address their cash flow, or if it will change their cash flow. We partner up with attorneys. We may partner up with financial advisors either within Eide Bailly, or if you have financial advisors outside of Eide Bailly, we'll partner up with them as well. But when we're looking at this from that tax perspective, we want to be sure that we can take that information from a well-drafted estate planning document, let's say, whether it's a will or a trust, and illustrate or flow chart how does that really look to our clients from a financial perspective. We may use flow charts, PowerPoint, spreadsheets, whatever is needed to help our clients understand what's in that estate plan itself. We want to illustrate it. So we have a really well-drafted plan, but sometimes it's hard to conceptualize it until you see the numbers, and that's where we come in and add the value. Implementation is probably the most important part of any plan. You can do a well drafted estate plan and even run the scenarios, but if you don't take the steps to really play out the plan as intended, you may not have gained anything. And if you don't follow through on that plan, what you thought was going to be out of your estate actually may still be in your estate for estate tax purposes. So with that, I'm going to get into where are we with some of these proposals that are out there. Like I said, there have been many of them, but I think the first starting point should be, where are we under today's law? Because as we plan, we want to know that we're planning under today's law, and then keep the proposals in the back of our mind, because we don't know what proposals will actually be passed. A lot is discussed, but what actually does get passed, that That is still to be seen. But we do know under today's law, we have an estate tax exemption and 11.7 million per person. So that means you can gift or die with estate taxes at 11.7 and not pay any estate tax. You can also transfer 11.7 million to a skip generation, meaning not your child, but the generation below your child of 11.7 million. It's great when we have a law that has all of these as the same level, which we have had for a few years. The progressive tax rate tops out at 40%. So anything over that 11.7 million, if we transfer that to our family members or someone, and there's a tax generated, it's going to start the tax at gifts over 11.7 million at 40%. There's no tax for assets gifted to charity or to your spouse because you have a free charitable marital deduction for gift and estate tax purposes. Portability, that is available to us right now, and it has been for a number of years. It's a great planning tool. It's really an after-death planning tool, in that if I died and I had 11.7 million, but I didn't use all of it at my death because maybe I left my spouse to my, or excuse me, my estate to my spouse, got a marital deduction. Well, my spouse could file an estate tax return and they could pick up that 11.7 million on their estate or for their estate going forward. So example, I died, I left everything to my husband, Jim. He doesn't have any estate tax to pay on my death because he has a free marital deduction. Jim files an estate tax return, he picks up my exemption, and going forward, when he gifts, he uses my 11.7 million first. If that exemption drops later in life, doesn't matter. He always has my 11.7 million as long as I am the last deceased spouse. And then he has his exemption, whatever that may be. These laws all sunset in January 1, 2026. Under the current law, on January 1, 2026, that 11.7 million is going to drop to 5 million index for inflation. So in 2017, when we saw the estate tax laws change, it was right at 5 million. Now it's indexed for inflation every year. In 2026, we think that's going to be about 6.5 million. There are annual gift exclusions, which one can give that's outside of your exemption. So in addition to the 11.7 million, under the current law, I can give $15,000 per person. It doesn't even dip into my exemption. That can be to children or my neighbor next door, whoever you choose. Under the current proposals, the first one came about in March 25th. That was called the 99.5% Act. And this is the one that you may hear of, associated with Bernie Sanders. He put everything in the kitchen sink into this plan. He wanted to, under this proposal, it addresses reducing the estate tax exemption to 3.5 million per person and the gift exemption to $1 million. Talks about the annual exclusion rules, which we know now we can give 15,000 to anyone or to a trust if we have rights for our beneficiaries within those trusts of any amount. Now that's limited under this proposal to 15,000 times 2, so only 30,000 if you're going to use a trust or gift through entities. The GST rules, currently there are some states that allow what we refer to as a dynasty trust. They can be in trust for my beneficiaries in the future. So if I gift to those dynasty trusts today, those assets are never subject to estate tax again in the future. Or some states have rules of those trusts could be in place for 500 years, or some are so many years of the last beneficiary named in the trust. Every state has little different rules, but it allows us to stretch those trusts out for many years if one family chooses to do so. The IRS under these, the 99.5% Act is proposing that the IRS restricts those to certain time frame. I believe it is 50 years is the longest that they're going to stretch that out to. There are changes to valuation rules. Right now we have the ability to discount for gift and estate tax purposes assets when we don't have a controlling interest. Those are lack of control discounts and lack of marketability discounts. It becomes a really big tax saver in the estate and gift world because we can transfer sometimes business interests that may be discounted 30 to 35%. That's a big deal when you're looking at a 40% tax rate. There are some limitations that were put into this proposal as to those discounts. There are also limitations on these proposals for grantor trust. A grantor trust is a trust where I create an irrevocable trust. So it's out of my estate for estate tax purposes, but I can have enough rights in that trust so that it's still subject to income tax to me as the grantor or the person gifting. So it's really disregarded for income tax. Even though I gifted it away, I still pay the income tax on it. And that income tax I pay for those beneficiaries is really a free gift to our beneficiaries because it doesn't use my estate tax exemption, and that tax I pay on those assets in the trust doesn't use any exclusion. So we use grantor trusts in a lot of our estate planning techniques, and it saves our clients significant dollars. That is one item that's in this proposal as well. The other piece is limitations on terms to grantor retained annuity trusts. So a grantor retained annuity trust is a trust where I give assets to a trust at a discounted value today, but I take back an annuity stream for that value today. So I don't have to use any estate tax exemption in this transaction because I'm taking back an annuity stream over a number of years. If I die within that annuity term, those assets may come back into my estate and be subject to estate tax. There's a retained interest. So there are some limitations under this proposal in regard to trust with retained interest. Then on March 29th, we saw the STEP Act come out, and this is because a lot of discussion because it eliminated the stepped-up tax basis on death. The benefit of having estate tax, if there is one, is that when there's estate tax, it allows you to step up your assets at your death to a new tax basis for income tax purposes. So for example, if I had a quarter of land that my dad inherited back in the 1930s and he died this year owning that land, there's little or no tax basis when my dad is alive, but when he dies this year in his estate, I receive that quarter of land at today's value. That's my new tax basis. That's a really big tax savings for a family. The IRS would not allow that stepped up tax basis if this proposal went through. So if this proposal went through, I would have to pay, as the recipient of my dad's land, gain on that land from what it was to what he had it back in the 1930s to if I sold it today. It could cause a lot of tax being paid. What's interesting is under these proposals, they're still talking about having estate tax and doing away with the stepped up tax basis. That is unusual. We have seen in the past where they've done away. In 2010, they did away with estate tax completely, and we were in a stepped up tax basis situation. But here in the current proposals, they're talking about still having estate tax and eliminating the stepped up tax basis. We then found the American Families Plan and the Green Book, which were released in April and May. And the Green Book is what's released to kind of clarify the proposals or add more detail to that from the current administration. And they gave us detail on how they would handle this elimination of the stepped up tax basis. Still not real clear. There's a lot of questions left yet, but it did say that there would be some exemption available. So you'd have $1 million to exclude out of this capital gain you'd pay on death. And it also pertains to gifts made. So if I gifted assets, I could generate capital gains tax, but I'd have this $1 million exclusion. If I had assets that were passing that were a closely held business or family operation, and that was passing down to a family member, there are some guidelines to kind of kick that tax down the road, per se, as long as a family member is operating it. But there's still a lot of questions on how all of that would play out. What is most recently before us is a House Ways and Means Committee proposal, which was released on September 13th. And this really addressed four main issues in the gift, estate, and tax arena. It addressed the gift, estate, and GST exemptions to say they would be reduced to $5 million adjusted for inflation. That would bring us to an amount somewhere around $6 million. It has the laws, or the provisions for changes to the grantor trust, has changes to sales to grantor trust, which I'll talk about here in a few minutes, and it addresses the valuation discounts as well. So for us, the good news on that House Ways and Means Committee proposal that came out is there were no comments regarding the deemed sales at death or elimination of tax basis step up. So the deemed sale at death, I think of it as like a transfer tax. That's that one where you'll have capital gains tax if I gift or leave my assets to others in my estate. That was not mentioned in this proposal. There was no mention of limiting the GST dynasty trust or limiting the annual exclusions to trusts or through entities. No comments about the limitations through the retained trust, like a GRAT. And nothing referenced about the increase in estate taxes and estate tax surcharges, because those comments have been in prior proposals where I've seen, comments of increasing estate tax at certain limits to 65%, which is a ridiculous amount. So even though this recent House Ways and Means Committee proposal was put before us on September 19th, that doesn't mean that any of these things can't be added back in when they really get to the negotiating table. But it is good news that they trimmed it down to just these four things and left some of these other things out of that proposal. The not so good news was that the House report, there was a House report issued on September 26th that said, let's clarify some of the provisions that were in that proposal on the 13th. And it all pertained to sales to defective trusts, which I'll talk to in just a minute. So for the estate, gift, and GST exemptions, that we think if that's going back to $5 million adjusted for inflation in 2022, that's going to be about $6 million. And to me, as we all throughout the year have heard these proposals, my thought is if you wanted to change something, the easiest thing to change would just have the sunset provisions happen sooner than later. And that's exactly what this is proposing. Those sunset provisions, which we know under the current law, they're going to happen in 2026. They're proposing that they happen in 2022, January 1 of 2022. So the exemption would drop to be about $6 million at that time if this proposal is passed. These again are effective after gifts made from December 31st, 2021. So you still have time to use this 11.7 million if you want to, but be aware that they could change in 2022. The gift tax exemption is the same for estate tax. So gift and estate tax the same. That's great. It's not reducing the gift tax down to this 1 million that was noted before. That makes it very difficult sometimes for planning. The changes to the grantor trust, well, now it says if you have a grantor trust, if you have a trust that's taxable back to the grantor, like me, if I was making the gift, that's going to be included in your estate when you die. So even though I made an irrevocable gift to a trust, I used my gift exemption at the time I funded the trust, if I have these rights where I'm still the taxpayer for income tax purposes, it's going to be included on my estate tax return when I die. So then I'm going to have to look at the value of those assets when I die, and that's what's going to be subject to estate tax with, we expect, a credit or some kind of reduction for whatever gift exclusion I had at the time I originally funded it. Distributions from those grantor trusts, if I have a trust in place and I make distributions as I go along, when the distributions are made, they're going to be looked upon as gifts being made anytime I make a distribution from those trusts, unless they are to a grantor spouse or discharging an obligation of the grantor. So if I'm the person making the gift, if that distribution is discharging an obligation of me, then it would not be looked upon as a gift. The grantor trust status, if that's terminated anytime along the way, because when we have these grantor trusts in place, most are drafted, so there's ability that I can turn off the grantor trust status years down the road. If I find that it's difficult for me to pay the income tax on these assets in the trust, I could turn off the powers that make that trust a grantor trust, and then the trust is responsible for the tax or the beneficiaries if the assets are distributed to the trust. The IRS is saying is if I return that power off, those assets would be treated as a gift on that date that I turn that power off. The power for adjustment will be made to, or excuse me, proper adjustment will be made to prior taxable gifts. So again, when I gifted it today and in the future, it's going to be on my estate tax return, there's going to be some adjustment where they give you credit for what was used in the prior year. We don't know all the rules on that or how that will look, but we believe that that will be the case. These are effective as of the date of enactment. A date of enactment means the date on which the bill is signed by the president. There's been a lot of confusion about what is date of enactment. So it still needs to go through the House, the Senate, and then it hits the president's desk. Once the president signs it, that's the date of enactment. There was some scuttle going around in Congress that this was as of the date that the proposal was put in place. And there has been clarification on comments in Washington. And we have two fellows that sit in our Washington office, and that's all they do is they listen to the conversations happening in Washington. And they emailed me last week and said the clarification is that this is as of the date of the enactment. If you have a trust that was put in place before the date of the enactment, your trust is grandfathered. However, if you add contributions to that trust, that portion of that contribution that you put to that trust, that is going to fall under these new rules. So how does this play out for what we have in place right now and as we do planning? Well, two things we use a lot in our planning are spousal access trusts and intentionally defective grantor trusts. The acronym for both of those you may hear of as SLATs or IDGTs. A SLAT, again, is a trust I set up for my spouse, and my spouse can have the income stream. I can use my exemption today, but as long as my spouse has the income, I don't lose the cash flow. I'll touch on that in a little more detail as we go along. And an IDGT is just an irrevocable defective grantor trust, meaning it's an irrevocable trust, but it's defective because I'm the taxpayer of that trust because of those certain rights in that document. That's why they call it defective. If we create those trusts now before the date of enactment, we're going to have those trusts grandfathered in. So right now there's, really no change to the planning we're doing. We're still moving ahead with it until we know that there's going to be a new law. It's not clear under the proposals what will happen if we set up something like a GRAT or a qualified personal residence trust. So under a GRAT, again, that's a trust that I create. I gift it today to a trust at a market value or discounted value, and I take back an annuity stream. Or in a QPERT, a qualified personal residence trust, I put my residence in a trust for a number of years, and then it goes to my children. I get a discounted value as I put that into this trust because of the term. Those have a retained interest. If I die in the time that the annuity is in place or the term in a qualified personal residence trust, it comes back into my estate. It's not clear what's going to happen on those trusts that are created even after enactment and created before enactment. We'll have to get some clarification on that. QSSTs are qualified subchapter S trusts. So if you have made an S election for your business entity, only certain trusts can hold S Corp stock. One of those trusts is a qualified subchapter S trust. And in that trust, you have to have only one income beneficiary, and the income of the fiduciary accounting income, the income that comes into the trustee's pocket every year, has to be distributed out to that beneficiary. It's not clear under the current rules how this will be looked upon as an possible inclusion in the beneficiary's gross estate, because it's not really a grantor trust back to me, the grantor, but the beneficiary gets to have that income taxed to them. So we're a little unclear in how the final rules will play out in regard to the qualified subchapter S trust. As to irrevocable life insurance trusts, those we use a lot in planning, that if I want to use life insurance to maybe pay my end of life expenses, including my estate tax, I might create a trust and fund it with a life insurance policy or dollars to pay a premium on a life insurance policy. So I make a gift, let's say cash, into this irrevocable life insurance trust. The trustee buys the policy, and that policy proceeds, because the trustee bought the policy, not me, the grantor, it's out of my estate for estate tax purposes. Here, some of these irrevocable life insurance trusts are written where they are grantor trusts. One of them being if I have assets that I've put into that trust and I use the income from those assets to pay the premiums, that makes it a grantor trust for income tax purposes back to me, the grantor, the gifter, person gifting. What will happen after this new law? Because now I was using that income, I don't want this trust to be included in my estate, especially when I have maybe a large life insurance policy in that trust. It's going to be interesting to see how that plays out. The other question we have in regard to the insurance trust is, how will existing trust fund the premiums if it's a grantor trust or if it can't receive additional gifts? So even if I'm not using income to pay the premium, but I have the trust set up where it's going to be considered a grantor trust, I can't gift to it, because if I gift to it, then a portion of that trust is going to fall under those new rules. If I have a $10 million policy under that trust, will that make a portion of the $10 million policy subject to estate tax when I die? There's a lot of questions there on how that will play out. The other thing in the proposals, back to the one from the 99.5% proposal, if you remember that, they limited how many annual exclusions you can put into a trust to only 2. So 30,000 can only be contributed into a trust. If I was contributing more than 30,000 into an ILET to pay the life insurance premium, how will that play out in the future? So there's a lot of questions we have in regard to the ILETs. As to the sales to the grantor trust, the grantor trust rules will be ignored if there's a transfer, and there'll be a deemed sale between the owner, me, and the trust. So right now, if I have an irrevocable defective grantor trust, if I have that grantor trust in place, I could sell assets to that trust and take back a promissory note for whatever discounted value those assets are today. And any appreciation in those assets, that's out of my estate, because this trust is out of my estate. Any assets that are put in there or sold to it, if I sold assets to the trust, but I'm still the taxpayer for income tax purposes, there's no capital gains to pay because it's a disregarded taxpayer. I'm the same taxpayer as the person selling the assets to the trust. If I sell the assets to the trust, take a note back, really what I'm doing is I'm taking the discounted value back. That's what's in my pocket today. The stock, let's say, if it was stock I sold, that's out of my estate sitting in this trust. And if there's any appreciation on that trust, going outside of my estate tax free. Under today's law, that's a great plan for us because I just sold it, but I didn't have to pay capital gains tax. I got all the appreciation out of my estate. I got the value of the discounted value back today. I was getting that probably in company distributions anyway. Nothing really changed. Still paying the income tax as I was before. I have this promissory note that's coming back to me to help my cash flow. It's just at the end of the term of that promissory note, those assets are out of my pocket and out of my estate tax, or not subject to estate tax. It's a great way we can shift appreciating assets out. But under these new rules, it's saying that those sales to grantor trust going forward are going to be taxable transactions. I'm not going to be able to avoid that capital gains tax. And because it's my trust, we're going to have related parties in a grantor trust, and I'm not going to be able to take any related party losses that one may take if you're not a related party on a sale transaction. This is an effective date as of the date of enactment, but that not so good news that happened on September 26th said even though the grantor trust rules are after the date of enactment, a sale to a grantor trust going forward, even if it's a grandfathered grantor trust, meaning it was signed before the date of enactment, a sale is going to be triggering the capital gain. So initially, when on the 13th, when that law came out, it was like, well, that's too bad, but I could still do sales to these grantor trusts because they're grandfathered in, and as long as there's no gift element, I still have a benefit, but that's not the case. The sales to the grantor trust cannot go forward if this law passes. Well, they can go forward, but you'll pay the capital gain. We're not going to get out of the capital gain if this law passes. The valuation discounts, this is looking at your, let's say your business entities that we would take a discount for gift and estate tax purposes, for lack of control or lack of marketability, because I don't own 100% of the company. If I'm transferring a non-controlling interest, I can discount those assets on my gift tax return or my estate tax return. Now, under the new proposals, they're saying non-business assets in an entity cannot be discounted, and they would not be considered when valuing the entity. The non-business assets are defined as passive assets held for production or collection of income and not used in the conduct of an active trade or business. So exceptions to this would be reasonable working capital or real property in an active conduct of one or more real property trades or business if the transferor, me, if I made the gift, materially participates. Well, the thought on this is, okay, this is not as bad as some proposals that have been out there before, because they just wanted to totally do away with the discounts in some prior proposals. This is just saying that the non-business assets are not able to be discounted. So right now, if we have a family that has significant wealth, sometimes we put that wealth into a partnership or an entity, and sometimes it's all marketable securities for family asset management, and we take a discount on it. There are a number of professionals who are uncomfortable about that, and leading commentaries across the country who say, do you really get a discount if it's just marketable securities? Some say no, some say yes. We at Eide Bailly have taken the position that there's some level of discount, even if your entity just owns marketable securities. And now that we have this proposal out here, sure makes me feel much more comfortable taking the discount on the marketable securities, because they're saying they should do away with that. Well, if they're doing away with it, it must mean that under the current law, that is available to us. So very interesting that this is how they structured the proposal. Now, for an interest in a limited partnership, or as a transferring as the interest as a limited partner that is not materially participating, you're not going to get the discount. And that makes sense to me. You know, if you're a limited partner, you're not materially participating in the operations, there would not be a discount. Appears here that TIC property, tenants in common property, in real estate would still qualify for the discount. So if I own an undivided half interest in a quarter of land, the IRS allows us to discount it. And the rule of thumb really is 10 to 15%. In a number of audits maybe I've been involved with, that's been a discussion. Well, we know we have a 10 to 15% on tenants in common property. That will still appears to be allowed. It's the business assets within an entity is where we will have the issues on the discounts. This is effective as of the date of enactment. Other provisions that are changing, which affect income tax for estates and trusts, I think is important to point out. The top marginal rate is proposed to be increased to 39.6% for income above 12.5 thousand in a trust. So trusts are typically taxed at a higher tax rate, but this 39.6% is increasing that higher tax rate. And it's also including a surcharge of 3% for modified adjusted gross income in excess of 100,000, and maximizing our qualified business income deduction to 10,000, and also making changes to net investment tax. These are over and above just increasing the tax rate for trusts. It's making significant limitations here that could really create some additional tax dollars for trusts. These effective dates are for tax years after 2021. So as we manage our trusts and think about the taxable income within our trust, it's going to cause us maybe to think about that, because under trust accounting rules, income is taxed to the trust unless it's distributed out to the beneficiary. Sometimes we don't want assets distributed to the beneficiary for certain family dynamics or certain ages of our beneficiaries, but now maybe we want to reconsider that. Maybe we do want that to kick out, because if these rates go through under a new law, it could really make a difference. Where now in our higher net worth families, they're all in the highest tax bracket, whether it's the parents or the beneficiaries. So they don't really care if the trust is taxed in the highest tax bracket. But if we have some of these surcharges, it is going to make a difference. So you may want to consider decanting your trust to a new trust, if that's allowed under your state law, so that now you do provide for distributions out to the beneficiaries if these higher rates and surcharges do come into play. You also might want to think about going forward as planning with entities, because many times we have families who create a family entity and they take part of the, let's say, an S Corp and put it into a trust. Here, if we had a QSST trust where the income beneficiary, whether or not they receive the income, gets taxed for the income, that could be a really big tax savings here. If you had a trust where I don't want my kids to get the income for reasons of ages or other issues, other family dynamics, I could have an S Corp that kept the income within the S Corp. It didn't distribute it out. It just kept building within the S Corp for the family. But the beneficiary, because it is an S Corp in this certain trust, would have the K1 go right out to the beneficiary. You could be taxing it at a much lower tax bracket. The only thing we'd want to watch here is what are the rules going to be when the grantor trust rules do come out, if they do change, and is this still a possibility? Something to think about. Other provisions is the capital gains increase. That may change to 25% if the 39.6% rate applies. This would be effective the same date as individuals. And if you're familiar with 1202 gain exclusion for some business entities, that exclusion is going to be limited to 50%. Exclusion rates of 75% or 100% will no longer apply to trusts or estates. So if you do have 1202 gain exclusions, there's a lot of planning we can do sometimes in stacking those exclusions, but there will be some limitations on the rates, the exclusion limitations going forward. And this is interesting that these effective rates are as of the 9/13/2021, as we understand it today. So actions to consider as we move forward. Well, the time is now to plan. If you want to use your exemption, you have from now to the end of the year. You might want to look at your planning documents. 11.7 million is a big amount to transfer. If that exemption changes, do my planning documents still make sense in regard to portability and the flexibility? Is there a way I could set myself up ready to pull the trigger to make the gift if needed? That we could do with some of those sales to defective trusts I talked about. Many people are setting those up, and if they think that the bill is going to be enacted, they might just give the promissory note away. That's a really easy way to use your exemption. To me, it's deja vu of 2012, where in 2012, the exemption went from 5 million to 1 million. A lot of people wanted to use their 5 million before year end, and then we got to the year end, and then oops, it didn't change. We had a number of calls on January 2nd and 3rd saying, hey, can I get my $5 million back? And the answer is no, that's not how it works. If you gave it away, you gave it away. The only way you're going to get it back is now if your family gives it back to you, or sometimes you just can't even get it back if it's in an irrevocable trust. So now's the time to have those discussions, and the thing to think about is professional advisors are getting busy. You know, we have a footprint across 9 offices with 40 plus, or 9 states with 40 plus offices. I've had about 8 attorneys, 8 law firms across the country who have told me they're not taking any more estate planning projects. I think that's going to be becoming more and more. And even with us at Eide Bailly, it's going to get to a certain time frame where we'll be glad to work with you, but we're going to be very open on what we can really get done before year end. So if you want to use your exemption before year end, give us a call soon. Call your attorney, get working on those plans. Portability, as I said, there's no reference of portability going away in any of the proposals, which is great. This allows us some flexibility for after death planning and really makes it easier if I have a client who wants to use their exemption maybe from one spouse and leave the exemption for the other spouse, because with portability, we can shift whatever exemption we have remaining of the surviving spouse, or to the surviving spouse. Clawback, that's a term we've heard as these exemption amounts have been, changing over the years. There's always been a concern if you make a gift at a higher exemption today and the exemption drops, will the IRS claw back or tax you on that difference? So today, if this exemption is going to drop, we think in 6 million on January 1 of 2022, and I use 11.7 million today, will the IRS try tax me on that 5.7 million bonus? I look at the amount above the 6 million as a bonus. Will they try tax you on that? And there were final regs that came out in 2019 that said no, estate tax exemption at death is computed using the higher amount of the exemption applicable to gifts made during life or what's at death. So if yours was higher when you made the gift, less at death, you use the higher of the two, they're not going to claw back. I have seen some articles out here from some financial advisors who have questioned if clawback is coming back. To me, I do not see that anywhere in the proposals. I have not heard that from any discussions of the national commentators that we follow or from our fellows in Washington. I do not believe clawback is an issue as it stands today. And I'm glad to see that they had final regs in 2019 that hopefully gave some comfort to clients. Sunset considerations for gifting, thing to be aware of and think about these sunset provisions, whether it's 2026 or 2022, if that proposal happens sooner than later, that sunset provision happen sooner than later under the proposals. Remember that if the exemption drops to 6 million, and if I've already used 6 million, I have nothing left when 2022 comes around if that law passes. So I have some clients who say, hey, I want to use some of my exemption when we're at 11.7 million. I want to use that bonus amount, that 5.7 million. And I have to remind them, it isn't used from the top down, it's used from the bottom up. So if you use what you consider that bonus, the difference between 6 and 11.7 million, if you use that 5.7 million now, really what you're using is you're using 5.7 million of your $6 million exemption. When it gets to 2022 and they really drop it to 6 million, all you'll have left is 3 million of exemption. If you really want to get the full benefit of 11.7 million, you have to give your full 6 and your 5.7. That's a big number. So for some clients, we're having them maybe just use one spouse's exemption, use the 11.7 million, let the other spouse have their exemption, whatever it lands to be. If it is 6 million, they still have 6 million next year. And with portability, if they use a marital deduction on the first death, they can make that $6 million portable to the surviving spouse. Leaves us some flexibility. Here quickly, I want to just show you what a SLAT is. This is a very simple illustration. But when we talk about the spousal access trust, if you have a spouse that wants to use the 11.7 million, but really doesn't want to give up the income stream, because that's a significant amount of income stream typically on 11.7 million, maybe I create a trust and I transfer 11.7 million of assets from the grantor to the trust, and then I let the spouse be the beneficiary. That way, as long as I'm married to the spouse, I really get the cash flow. I just use my exemption by transferring it to the trust. I'll give my spouse the income stream for life. Really hasn't changed my cash flow, but I did get to use all of my exemption at today's value, which will benefit my children at some future value, at an appreciated value, estate tax free, when my spouse dies. So again, I put assets in here at 11.7. It's a non-controlling asset. It could still be discounted. I give my spouse the income stream for life, and at the end of my life, it could pass to my children or whomever. This income stream could be to the spouse, or depending on the terms of the trust, you could have discretionary distributions to children. We call those as sprinkling distributions to children. That usually affects who's going to be the trustee, but it may be your spouse doesn't need all the income sometime down the road. You might want to have your children as a beneficiary. With these trusts, there's things you need to be careful of. You know, you're funding the exemption during lifetime, and you're transferring your to a spouse for your to a trust for your spouse using your exemption today. The distribution could be automatic, 100% distribution, or you could make it a discretionary distribution of income to spouses and descendants. An independent trustee can have broad discretion of how they make those discretionary distributions. If you have discretionary distributions, probably need an independent trustee. It's not the spouse who's a trustee. This trust is not included in the gross estate of the beneficiary of the spouse, because if the spouse never had an ownership to those assets and all they ever have is the income stream, it's not included in their estate. Those assets will not receive the step up because I'm gifting them today. So their tax basis is today's tax basis. That's one thing that we can consider. And the other thing is you want to be careful. Sometimes I have spouses that want to do 2 spousal access trusts. Well, if this works well for one of us, let's do it for both. That's fine, but don't do it at the same time. Don't have the same trust. You don't want to fall under the reciprocal trust doctrine, where IRS really looks at it like it's really one and the same transaction. You just gave a trust to each other. Have some time in between the trusts, maybe different assets between the trusts. And maybe if you don't need the income stream, one way to get around this is maybe you have one spousal access trust, and if you want to use the exclusion for the other spouse, do that for the children. So instead of having discretionary for the children in the spousal access trust, have the second trust be for the beneficiaries. Here's an illustration to a irrevocable defective grantor trust. If I'm going to do a sale to that, I would sell assets to this trust and take an installment note back for the discounted value. I have to make a partial gift usually for this if I don't have other assets in this trust, because for this to be looked upon as a true sale, there has to be some equity, usually about 10%. So if I was looking at a $10 million transaction, I'd gift $1 million, and then I'd take an installment note back for $9 million. And then when the note is paid off, from the income that my $10 million of, let's say, stock earns, then I have no income stream coming back to me. These assets are available to the trust beneficiaries or may remain in trust for the future if you want it to go down to future generations. The benefit here is I'm transferring it today at this trust at a discounted value, taking a note back for that discounted value. So not only did I get the discount, say a 30% discount out of my estate tax free, any growth on the whatever assets are on here is going estate tax free. The benefit of this, again, is we can set ourselves up to pull the trigger later. If you want a gift, just give the note back. It really lets you make some decisions on short notice of using exemption. In this time where we have this exemption threat of being reduced, we found in 2022 that the appraisers, the business valuation teams were all running out of time to get the values put together before year end. We're seeing that again. There are appraisers that just can't guarantee that they can get their appraisal back by year end. I know our business valuation team in Eide Bailly has a lot of projects in the pipeline. You know, it may get closer to year end where people are looking for evaluation and they might not get that to you till after the 12/31 deadline. You can draft your assignment that you're drafting it based on value instead of a particular asset. So instead of saying I'm giving 25% of XYZ partnership, I'm going to give partnership interest in XYZ of a value of 11.7 million as finally determined for estate and gift tax purposes. That way, we know on our gift tax return, when we file that for you, we're going to transfer units that come up to be 11.7 million. And we'll determine that when the business valuation team has their valuation finished. We'll put that on the estate tax return. And then if there's even an audit and that value changes, we just change the units because it's based on, is finally determined for gift and estate tax purposes. It gives us great flexibility when we're rushing towards year end to do a gift. We want to use the exclusion, but maybe we can't get the valuation report back in time. If the unfortunate event happens where they eliminate the stepped up tax basis and have this transfer tax in place, triggering capital gains on a gift or an estate, it's going to change the way we plan. And it might make us look at more of how do we manage our capital gains going forward. We might be looking at harvesting capital gains over the years for our clients, or if we have some lead time to before this happens, we might be looking at how can we spread out the gains to different family members. Going forward, I think we'll use more charitable remainder trusts, because if you make a gift to a charitable remainder trust, you gift to a trust, you take an income stream back, the charity's the beneficiary at the end of a term or life, and they don't pay any capital gains tax. If we never have to kick out capital gain to me, who the taxpayer who's getting the income stream, that capital gain can be avoided. We also may see installment sales used as a planning opportunity as we're going to manage the gain. Family limited partnerships, we do that. We use a lot of family limited partnerships in our planning. It's a great way to manage assets between a number of family members. It makes it an easy way to use annual gifts. It allows buy-sell provisions between different family members. I still think family limited partnerships, even though they might reduce some of the discounting, if these laws or proposals do pass, are still going to be a great planning tool, more for the management piece of assets within families, if for nothing else. Considerations to think about as you're working with a plan. Estate tax apportionment. I see people making really large gifts of 11.7 million this year, using all their exemption, but if I made a gift, I just had one family I met with, they're gifting to 2 children using their 11.7 million. They're going to give to the 3rd child at the end of the 2nd death when they both die, husband and wife. That's when the estate tax is going to be in play. Well, if that child is getting all the assets at the end of that period, is he going to be subject to all of the estate tax? And those other 2 children who received assets in the earlier years, like this year, didn't have any tax to pay. Is that fair? Maybe not. So you want to think about how are you going to pay that estate tax if there is some, and if I've benefited some children now and my other child or children are not getting those assets until a later date when the tax is going to be due. What is fair is different for each family. So that's where us running the numbers sometimes can help some of those decisions in our flow charts or our Excel sheets, PowerPoint presentations, can put numbers to the plan, because many times I see people, we have a great planning document. Now, when we put that with your financial statement and put numbers on how the assets transfer, At the end of the day, I can show you the buckets that each child is receiving, the tax that they'll be responsible for. Does this make sense? Then sometimes we have to make some tweaks if it doesn't. The other thing is liquidity for payment of estate taxes. Again, is there enough cash to keep the business in operation? If we do gifting, does it make sense? Life insurance needs, how is that going to play out? Will it cover all of our debts? I have a life insurance trust in place that has multiple annual exclusions right now that it uses to pay the premiums. But if I don't have those annual exclusions under these proposals coming forward, I might have to make some changes. So questions, I see I have a couple questions in the queue here. First one is, if the taxpayer died in 2021 and is not required to file 706, can they file a 706 to maintain the 11.7? So there are many times we file an estate tax return just for portability reasons, meaning we don't have a requirement to file an estate tax return, but we want to file it because we want to get that 11.7 million transferred to the surviving spouse. Now, if you had a filing requirement, but you didn't owe any tax and you didn't file the return, there's no way to file a late return. But if I did not have a filing requirement because I wasn't required to file the 706, you may be able to get some relief with a private letter ruling. So you file the return, you prepare the estate tax return, and you submit a private letter ruling. We're having very favorable answers with those private letter rulings to let you file those late returns. We're getting a number of them. So if you find yourself in that situation, give me a call. I will point you in the right direction to have a conversation and see if you can still take advantage of a late filing return, because maybe you didn't think you needed that 11.7 million. But if they drop the exemption to 6 million, maybe now you would need it. So you would want to probably look at weighing the cost of doing a private letter ruling to file a late return. And I think that was the only question I had. Perfect. Okay. Well, if anybody does have questions after our session today, feel free to contact me. I'd be glad to answer your question or point you in the right direction. Thank you for taking time with us, and I hope we answered some of your questions. And I wish I knew, had a crystal ball to know where these proposals will land, but we are watching them closely. So watch our insights. If we see something that changes, we will surely let you know. Thank you, everyone.